Good morning. Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting and online research tools. Every Wednesday at 9 a.m. we post to YouTube a webinar covering a variety of market topics. Some weeks we'll talk about national housing market conditions or conditions in a particular state. Occasionally it will be an MSA or region. Today we're going to do a special topic. What are the financial markets telling us about housing market economics? I'm John Mulville. I'll be presenting today. Please join us the next 2 weeks as Mark Bowd presents the state of California. We're splitting that into 2 pieces, so put that on your calendar for the next 2 weeks. Today, what are the financial markets telling us about housing market economics? Let's make a few comparisons. Why are the financial markets relevant? Why should we look at these indicators? As market analysts, we're always looking at indicators, but why financial markets? Well, let's compare. In the housing markets, there's few transactions. Even in an entire city or master plan, the number of active communities can be quite small, and the transaction count is quite small. So the data population and set is just by inference quite small. Each product is unique, even if it's the same floor plan in the same development. These homes are on different lots, they face different directions, they have different exposures, yard sizes, exteriors, elevations, so they're all different in their own way. Buyer qualifications in the housing markets vary widely. Some people put zero down, most people put a small amount down and borrow the rest, but people do come with money and there are cash buyers, so qualifications vary widely. Markets are slow to respond to economic conditions. Most people will buy when they have family needs, or it suits their employment, they happen to have money at that particular time and a steady employment situation. Buyers tend to be inexperienced. Most people only buy 4 or 5 houses over the course of a lifetime, and you don't gain that much insight into how each transaction works when they're spread out over that much time. And most housing market price information is poorly disseminated. Let's take a particular housing transaction. When the price finally records weeks or months after that contract is initially signed, what's included in that? Options, upgrades, concessions, premiums, buy-downs. In many cases, we're dealing with a variety of components that go into the aggregated house price. Now compare that to the financial markets. In many of the commodities we're going to look at, there's thousands of transactions every day, and the product is completely standardized. Everybody knows what the lot of lumber looks like in terms of size, price, delivery location. All those factors are completely the same. Buyers tend to be very well qualified. They're commercial participants, representing suppliers, representing steady buyers, so they know precisely what that looks like, where it's going to, and all the features, characteristics, and history associated with it. These buyers tend to be quick to respond to any changes in sentiment or news. They know precisely how a variety of factors are going to translate into the market action for these products. Again, buyers are extremely knowledgeable, they've been around the block, and that means that their sentiments and their opinions goes quickly into prices, unlike the housing market. And the price information is rapidly disseminated. You can look at these exchanges, look at these indexes, and know within minutes if there's a price trend change or some change in sentiment that's going to affect the market going forward. What markets are relevant to housing that we can look at? Well, today we're going to look at interest rates, materials costs and production costs, industry groups that relate to housing construction, and last, industry groups that relate to employment. First, let's start with interest rates. Many people find interest rates to be confusing, in part because interest rates move inversely to prices. That means when prices are rising, rates are falling. Interest rates are priced in 30 seconds instead of decimals. So it's 103 and 2/30 seconds. People don't understand that as quickly and readily as they do decimal points and straight prices. There are many different kinds of bonds. That's really not our point here, but what we'd like to talk to is what's happening in long-term rates and how does that apply to the housing market. This particular chart shows 10-year U.S. Treasury yields going back to about 1980. On the right side of the chart, the way this index is structured, the price is shown with the decimal place one spot too far left. So just for reference, if you look back to about 1981, the prices peaked out at about 15.6% interest for a 10-year treasury. What has happened in this market in 30 years? Prices are steadily going down through economic recession, through economic expansion. Generally, we're in a deep-seated, long-standing downtrend that's now taken us down to about 3%. There's a lot of reasons why this goes down. The U.S. is the international reserve currency. There's been a lot of improvements in terms of freeing up capital flows, electronic and political, so money moves around the world much quicker, and that tends to bring prices, yields down over time. Here's the same treasury shown over 3 years. The gray bars in the background are the interest rates. Shown up front in the black line is the S&P 500. We're going to use the S&P 500 today as a comparison metric in a lot of our industry groups and price comparisons. We recognize that the S&P 500 is not the economy, but in terms of financial products, it's a good base reference for some of the comparisons we're going to make today. In looking at interest rates over the 3-year period in this particular chart, we can see that rates have tended to range between about 3 and 4%. Now, this chart history goes back to the beginning of 2008, so about a third of the way left on this screen, you can see where the Lehman Brothers credit collapse started to take place, and very, very low rates evolved into December of 2008. We've been bouncing somewhat higher over the past year and a half, but still, overall, on a 30-year basis, rates are trending down. As we mentioned a moment ago, prices move inversely to yield, so the record high price levels shown here, this is an August delivery, Fannie Mae 4.5% coupon. These high prices translate into record low mortgage rates on the ground. I'm sure everyone's been hearing this on the news. We seem to break to new low rates, new high prices almost every week, and this is news that may go forward a little bit here. Here's a 30-year mortgage rate, national, fixed mortgage, over the past 3 months. You can see the downtrend in place on this particular instrument. Again, very low rates available across the country. So what's this telling us? There is a very deep-seated long-term trend toward lower rates, in place over the last 30-plus years. Now, markets can change, markets can pivot, we can have exogenous events that make this change, but overall we're going to get some notice. We're going to get some market gyrations. We're going to hear some noise, if you will, get some static out of this if this market changes and moves the other direction. Periods of low rates tend to be associated, especially on the short-term period and with short-term rates, low rates tend to be associated with weak economic conditions. You could clearly see this in our chart of the 30-year when rates dropped into late 2008 and early 2009 in response to the credit meltdown. Demand for government securitized mortgages, mortgage guarantees, guaranteed product is keeping rates low. Investors across the world want these rates, and if it's guaranteed by the government, there are usually buyers. There's frankly other reasons to hold these things too. Many people assume, why would I want a 10-year instrument that only pays me 3%? If you're in a period of declining rates and rates go from 4 to 3, your bond experiences a substantial capital gain. So there are reasons to hold this outside of return and security. Many people, particularly in today's environment, are expecting much higher rates or thinking that rates are much higher because of the budget deficits and the big hole in our economy. History has shown that this takes years. This may take years to manifest itself, and it's a very complicated, often slow to develop process when our excess budget spending translates itself into much higher rates. So we could continue to see lower rates over a few years, without really a defined point in time when a change is due. That's our coverage for Part 1. Please join us for the rest of the series.